to start off with the macroeconomic landscape. Obviously, we have a very important week this week as the central banks around the world, or at least in the developed world, are meeting today with a lot of eyes on what's going to happen there. And so starting with the macroeconomic landscape, why don't we look at where central bank policy rates are today? And so this is a chart we used to use many years ago. Thought we'd dust it back off again now that we've been in a hiking regime. And one thing that I found very curious about this is that nothing happens in a vacuum. And if you look at the various banks that we're seeing across here, it really seems like in general, when there's a cutting regime, it's happening across many banks. And when there's a hiking regime, it's coming across many central banks around the world as well. And so not shockingly, inflation tends to be somewhat of a global phenomena. The reason being is a lot of the things we consume, we all consume irrespective of the jurisdiction we live in. But what you see here is it's not just the Fed that's been on a torrential pace in terms of its hiking campaign. But if you look across the globe, you can see here that there's been meaningful hikes across most of the developed world. And so the one kind of standout or holdout here still is Japan. You can see there we've color coded this in terms of the extrema of the readings, and that's why it's red there. But you can still see Switzerland even at 175 is still kind of that red as it is one of the lower rates in the developed world here. And so if you take a look at the expectations, though, and what this does, this takes the last roughly 9 months or so, and I'm sorry, it takes the last, make that 21 months or so, and looks at what the hiking process has been. It's just trying to give a sense of when the hiking regime started, having that flat line going in, but also importantly, see those dotted lines, and those are market expectations of where policy goes. And why I point this out is that it sure seems to me that at least from the market expectations, again, the market can be wrong. If you recall last year going into 2022, the idea was that the Fed may be able to hike 50 basis points over the course of 2022. And we all know that they delivered over 450 basis points of hikes. But you can see here that the market is starting to believe that in most instances that the central banks, at least the ones we're showing here in the developed world, are done with their hiking regime. You can see that the U.S. is not expected to be the leader. The U.K. At the Bank of England, it has that crown of being almost 6%. In terms of its terminal rate, at least from the expectations of the market. But notice that the market is saying that the Fed is likely to deliver a hike at tomorrow's meeting. And then from there, it's a coin flip whether or not they actually continue to hike from there. And so when you think about it, the expectations are why the Fed is trying to induce this hiking regime is to make sure that you can make things more restrictive. And one way of doing so is making real yields positive. And what I mean by that, borrowing costs are more punitive than the inflation rate. And so an example that you can see here on slide 11 is this shows the real Fed funds rate. There's also this market implied policy rate today versus where it was 3 months ago. That's the blue versus the yellow. But that gray or the blackish line there you see is the real Fed funds rate. And this is taken by taking whatever the current Fed funds rate is and subtracting the latest one-year inflation rate. So you kind of have a backward-looking inflation measure complemented with the current Fed funds rate. But essentially, it gives you a sense of are cost restrictive or are market conditions restrictive enough, and that is generating a positive real yield. And so take a look here. What you saw from the pandemic is that we had deeply negative yields here, right, in terms of real rates. That's because you had a very high inflation rate, you had very low Fed funds rate, and so you put those two things together. No wonder the Fed embarked on this high hiking cycle. Now, this isn't something that's costless. We all know about the increased borrowing costs of the U.S. government by hiking this, but one other thing to notice, too, is that you can see the impact it's had on the Fed's balance sheet. And so the Fed used to have what we call a positive carry trade. That is, they borrowed lower. That is, they had a lower rate that they were paying out on their deposits versus the assets they own. Remember, they were owning treasuries. The bulk of their balance sheet sits in treasuries and mortgage-backed securities guaranteed by the U.S. government. But you can see that changed as they embarked on this hiking campaign. One is the coupon on their portfolio is simply below the borrowing costs, and they continue to ratchet up those borrowing costs. So if you were a corporation, this is a good way to go out of business. But fortunately, the Fed doesn't have to suffer from that side. But there are ramifications of this. And for all of this tightening that the Fed has embarked on, there's another way of thinking about financial conditions. And Bloomberg does a calculation where they distill it down into roughly 12 different kind of metrics that they compare whether these are creating a more accommodative environment. So, for instance, if you think about when high yield spreads are rallying or they're tightening relative to treasuries, well, that's actually easing conditions or more accommodative. And the vice versa scenario is when you have tighter conditions. You can see here that the bulk of these measures of the last, let's call it 6 or 7 months, have actually been more accommodative. Well, why is this? Well, interest rates were higher. They peaked late last year across most parts of the curve, and I'll show you this later in the presentation. They peaked in October of last year. The 2-year Treasury has kind of flirted with newer highs since that point in time, but 5s, 10s, and 30s, for instance, have been are lower rates today than they were back then. And so some of these ideas that effectively, even though the Fed continues to tighten policy, it's kind of led to a more accommodative environment because spreads have come in on a lot of these products out there. And so in general, what this does is that it almost flies in the face of what the Fed is trying to achieve here. And so remember, when you talk about Fed policy, the goal is to slow down the economy. By tightening conditions, the Fed is trying to engineer a slower economy. And that goes through two really transmission mechanisms. The first is making borrowing more expensive, right? We saw that in the Fed's own balance sheet, right? That if you have to pay more to borrow money, that effectively should slow things down, or at least make credit less attractive than it was prior to having lower rates. And secondly, it's to induce savings. And so those are the two things that the Fed is trying to do through the higher policy rates. And so we know that some of those first few hikes did not curtail the lending standards or did not curtail kind of lending out there in the economy, because a lot of the debt was refinanced at very low rates or financed at low rates. But also, I think there was this kind of belief that from the consumer side, that effectively that the savings rates weren't good enough to warrant what we've seen in the inflation regime. And so this was not really slowing down the overall policy, or the policy itself was not slowing down the overall economy. And so we'll have to see how some of this continues to play out. But let's take a look at some of the measurements of economic activity. And if you take a look at something called the Fed's, the New York Fed puts out a weekly economic index. That's the blue line on the graph here. And you can see that it kind of lines up relatively close, or at least the directionality with U.S. GDP. And so we do get U.S. GDP this week. Unfortunately, we get it after the Fed meeting. The expectations are for a relatively decent print in the second quarter. This will be the first estimate that comes out on Thursday, and it's expected to be about 1.8%. You look at GDP now, it's been running around 2% or so, and it's really consistent with what we see from this weekly economic index. And so you have this kind of this economy that has been doing better than the expectations. I'll show you that in the next few areas. But you also had inflation that's come below expectations as well. So in general, you kind of have this like sweet spot, or this Goldilocks scenario that's transpired the last couple of months, where economic activity has picked up, and at the same time, inflation has been more disinflationary. And so in general, this is kind of the sweet spot for the overall economy today. And you can see here relative to expectations, what the economic surprise does, it says, okay, where is the economic data pointing today when you amalgamate a bunch of these economic indicators? What does that look like relative to the expectations from professional forecasters? You can see here that the Eurozone continues to disappoint. Yes, it's an uptick, but it's still very much below expectations. If anyone saw the data out there on the BLS report from Germany, or the IFO lending standards out there in general, the IFO economic activity, it looks pretty ugly out there in Germany today. And so the Eurozone continues to disappoint. China's obviously been significant disappointment relative to expectation. The reopening trade was on the lips of every strategist at the beginning of this year. That has not, that at least has failed to materialize to date. But notice the U.S. What was it, like 60 to 70% of professional forecasters were saying the U.S. would have a recession this year. And what you see is that the economy continues to deliver above expectations. And so this is why you've likely seen a rally in risk assets, whether that's on the equity side of the equation. Some of that's been fueled by AI and some of those kind of thematic trades. But also you've seen it in credit spreads as of late as well. And again, this is kind of that sweet spot of the cycle that's being able to drive that. So the question is that will the sweet spot continue? Are we in this kind of no landing scenario? People talk about the soft landing, hard landing, no landing. The no landing scenario is getting a lot more play right now. And so let's take a look at some of the other indicators we look at to see if we think that this can continue on. And so one other way of thinking about measurements of the economy is to distill it down between manufacturing and services. And manufacturing is a smaller piece of the economy. Services comprise something like 75, 80% of the overall economy here in the U.S. And so what you can see here is that this is measuring economic activity. So when the line is below the 50 reading, that says that it's more contractionary. There's more participants that are saying negative things or a contractionary environment versus an expansionary. And what's above 50, there's more response giving that in the affirmative. And you can see here that manufacturing has been really mired in this kind of contractionary environment for a long period of time now. It's been over 12 months at this point in time. But you notice it hasn't drug us into a recession. And that's because of the services continue to hold their weight. And in fact, they've had a couple of nice upticks. So we've had a couple of very low readings where they got below that 50 mark. We got that in the first printing of the year on the January print, which is from December data. And then we got another really low reading as of late. And in both cases, it's bounced off it. And so this is where people talk about the resiliency of the consumer. And I do think there is some merit to this. I mean, you're seeing that there is economic activity out there. Those last ISM services, everything about this report was very strong. You had this increase in activity. You had more jobs being created. You had lower prices paid. The input costs were coming down as well. So in general, all of these things are pretty accommodative. And so this is one of the few economic indicators that continues to be relatively, it remains relatively strong and does argue for us not going to recession in the near term. On the other side, we've seen a really big contraction in the credit conditions and the availability of credit within the overall small to medium enterprise. And so this was obviously something that was a big concern, given that we saw the banking crisis or the banking challenges, whatever you want to call it, the failure of three banks back in March and April of this year. And you saw prior to that, even before we saw these bank failures, you were seeing a reporting of significantly tightening of credit conditions. That's an orange line. But then there was this availability of credit that really shrank up. And so this availability of credit in diminishing does cause some concern out there, is that small businesses and medium enterprise have been one of the lifebloods of the economy. That's where a lot of the job creation has transpired over the last 18 months or so. You see the headlines, the big layoffs are coming from the big corporations, but this has really been one of the areas where there has been strong growth. And so if conditions continue to tighten here, and also there is this lack of availability of credit, again, because of any stress within the small to regional banking sector, it could spill over to this part. So when we look at these, look at the NFIB surveys here, it's very important to continue to monitor this, as this could be something that says potentially as a harbinger of things to come. And why I point that out is that if you lose availability of credit, credit being the lifeblood of a lot of these corporations, was revolvers, some sort of term financing, it can spill over to the overall economy. Also, the other thing is that it's not shocking that conditions are simply tighter, because prime borrowing rates now, if you have a prime loan, the prime rate's 8.25, set to go to 8.5 tomorrow. So you already have the stress on there. Plus, by the way, there's typically a spread associated with that. So you're talking about the availability of credit. You're now borrowing the double-digit rate. So this is something to keep your eyes on. There's also something called the SLU survey We get that data print next week. It's a senior loan officer opinion survey out there, which talks about the availability of credit as well. So these will be things to continue to watch over the next few data prints. And another thing is that we've also noticed there's a meaningful contraction in C&I loan growth. And so although the loan growth is not negative here, this is with a 1-year lag. What we notice is that the leading economic indicators tend to really push in the direction of loan growth as well. And so when you're seeing a contraction in forward-looking indicators, tends to, again, mean people are more cautious, and therefore we've noticed this in the loan growth side of the equation as well. So again, if there is, even though the capital markets are functioning well, that is corporate bonds, the leveraged loan market, this is something to obviously keep an eye on as well. And we know some of the deposit flight out there that's transpired at some of the banks. It looks like there may be a merger of two banks post-close today, or at least an announcement at some point this week, as one of these problematic banks is reporting earnings today. Sure doesn't look good when you're announcing that potential talks on the day of your earnings release. But what we found here is that this deposit flight that we saw, that's the red line going down since March of this year, mainly that money has showed up in money market funds, and that's that blue line. And why I point this out, this isn't something dramatic that no one else has pointed out to date. But what's very interesting about this is that this money market fund, I believe that this money, it went from areas where you're earning little to no money on your deposits, right? You're making probably basis points on the deposits you had there. Now you earn something with a 5 handle on it, right? Government money market yields 5, T-bills, depending on the part of the curve, 5.5, 5.75 in some instances if you're willing to go out almost to a year. And so what that means is that this money that's sitting in these money market funds, I think, is dead money for the time being, meaning that people don't really want to spend it. We saw an inflation print that was sub 3 in the last reading. You're getting 5 something on your money. Why do you want to go out and take risk in market today when you can be able to earn that? So I just don't see this money leaving money market to go buy stocks or to go buy bonds at this stage. I think people are very content earning 5.5%, or it's roughly, call it 5.25-ish, probably after tomorrow's Fed hike. And that allows you to really generate a pretty profitable return, right? Now, there's risk to that, of course, that you ultimately have to reinvest that money at some point. But as long as the Fed stays in this kind of elevated rate or at the levels they are today, that means cash rates stay the same. And so it is pretty interesting to see here. But I think this is another reason that you don't see a lot of money in motion, is because, again, it's a good enough type of yield to sit in the money market today. One other thing that you don't see very often, you can see here that the same store sales, this is weekly, so it compares year over year. The data gets released weekly. That's why it says weekly in front of it. But you can see here that typically, at least, since in the last 12 years, that you haven't had it go negative outside of a recession. And so now you've seen some contraction in same store sales year over year. Again, it doesn't mean that the economy is going to collapse, but it's one of those data points that says, usually when we get to these levels, it's worth taking a pause and looking at the overall economy. And so in general, what we're seeing is that there is some strength in the economy. There has been strength in the first half of this year. It's delivered above expectations, as we saw in the U.S., and it's something that's led to the rally in risk assets. So the question becomes what it looks like going forward. And so I think at this stage, higher rates are going to start to kind of leak into the overall system now. We're going to see more of kind of a curtailing of this economic activity due to these higher rates, plus the idea that cash earns such an attractive yield today that it's likely to actually defer some of that consumption and spending. Now, I don't expect that over the course of the summer. I think people are going to take their vacations. We're going to continue to have, a strong August or so. But I'm curious to see what happens once the loan forbearance programs go away starting in September, and you start to see a newfound payment for 44 million Americans called their student loan payments that they haven't made in 41 months. But let's talk about inflation, because that's what's going to continue to keep the Fed, their eyes and their foot on the accelerator of trying to keep the hikes. And so let's see what the economic data shows us on the inflation front. So one thing we like to look at are import and export prices. We call this kind of the old school way of thinking about inflation, because these don't have all these hedonic adjustments and all these tweaks and things that you get from the BLS. Just says, what was the price of this? We sent it out. What do we charge for it now versus what we charged a year ago, and vice versa on the stuff we pull in. And notice here that when we had the inflation, it's because the cost of goods, both imports and exports, were going up meaningfully. Now they're starting to contract a fair amount. And so this should put some downward pressure on prices. Speaking of, if you look at manufacturing input costs, the prices paid index, this is again one of these diffusion indices. Sub 50 means that it's contracted. It just means more respondents are saying that there's price decreases over increases. What that should do is put pressure downward on overall prices. If you look at PPI, these are the producer price index. So it's like what, the CPI is the consumer price index, the inflation rate that we end up paying, but the PPI tends to lead CPI. So when you see PPI coming down, the red line is the level here, and the blue line is the year-over-year change in the overall level. And so you can see that we're actually seeing the PPI actually be deflationary at this point in time. Now, this doesn't have to translate into lower prices for the end consumer, right? Another way of doing this is that you can keep the price constant. If your input prices go down, your margin goes up. But ultimately, this should have less price pressure on the overall input costs, and therefore could help kind of this disinflationary trend continue. Now, if you look at CPI, you can see that we had a massive drop down in CPI on this core side over the last couple of months. And a lot of that's been, due to base effects. If you actually look at headline CPI, which includes food and energy as well, that actually had the below a 3% rate. It was 2.97 if you're using 2 decimal points there. But you can see here what the main piece of driving this inflation rate today is shelter. And so when the Fed is saying that we're going to look at core services, that shelter, that's that yellow area there, I kind of scratch my head and say, why? First of all, core services ex shelter means we take out all the consumption of goods, right? There's no goods in there. There's no shelter, so you don't have to live anywhere. There's no food, so you don't have to eat. And there's no energy. You don't need to do anything. So if you strip all those things out, there's not a lot of inflation. Well, guess what, Jay? Look at the yellow shaded area over the last 30 plus years. What you see is that area, again, its contribution to overall CPI, it's almost relatively a constant number. Yes, in late 2020, it got a little bit smaller than in normal circumstances, but notice that it's never went negative over the last 30 years. So it just seems a bit disingenuous to really be focusing on this piece, as it's things like education and healthcare, which are practically indexed to inflation anyway. But if you take a look at the gray area, goods inflation, this is part of the story where we had the supply chain issues. And so the good side of the equation was driving some of this spike. But notice that blue area. Well, blue area is shelter. We all know what's happened with shelter prices. Today, we got Case-Shiller indices. They were a very strong reading month over month. I think on the aggregate, we're only about 1.5% off the highs that we set last summer. And so when you think about the pressures that are supposed to come from shelter and bring inflation down because they operate with the lag, well, all of a sudden now you have this tick up in house prices over the last few periods. Now, you get kind of mixed reading on rents out there as well, whether or not, it depends on kind of the urban area you're in, the suburban area, what rents actually look like. But in general, I think that it's going to be hard pressed for this number to come down meaningfully in the next couple of quarters. And so hopefully the Fed isn't just continuing to look in the backward, look in the rear view mirror and be backward looking. Inflation tends to be a backward looking phenomenon. It tells you what the inflation rate was, not what it's going to be. And so again, this is a chart that says the Fed can continue to hike as long as they want to. Obviously, the more they do, the more pressure it puts on the economy. But what you'll see is that it's really, even though we all had expectation of inflation coming down, if you look at relative to the consensus, what you see is that inflation's actually been delivering below the expectations for the last couple of prints. And so you can see the spike in inflation relative to expectations post-pandemic, but now we're starting to see some of that reversal. And notice here that the economy during the post-GFC era pretty much delivered below market expectations or below consensus expectations on inflation throughout the entire period. So the question is, will it continue to decelerate, or will it end up continuing to press up? And so another way of looking at this, if you look at where this is headline inflation now, because this is what a lot of the forecasts look at. But you see there that there's the Economist survey. You can see that dotted line. We've been using that for a period of time just to show how much that inflation was expected to go down, but it delivered even lower inflation. Some of that has to do with energy prices, by the way. If you look at the year-over-year comparison, this is near when we had the peak in oil last year after the Ukrainian invasion. And so you can see here the market implied expectations are that it goes down, it kind of stabilizes around the 2 to maybe like 2.5 to 2.25%. Well, let me show you on the next slide. It shows you exactly where it's at. This is different parts of the inflation curve. This is what we call the break-even inflation rate. This is the rate that if this inflation rate materializes, it makes you agnostic from owning tips versus nominal treasuries, or what we call treasuries. There, you can see the market pretty much says 2.25 to 2.35%. That's going to be the new level of inflation. And you can see here that we have for a while there, the market started to think that potentially inflation may be a little out of control in the next 5 years or so. But notice even at the levels we are today, yes, they're above expectations where we were pre the COVID environment, but they're not materially unanchored. And so when you listen to the Fed, they always talk about they never want inflation expectations to get unanchored. And so again, this also says that maybe inflation is indeed transitory, and we should all just be chill about it for a period of time. If you look at real yields, they've been on the move upward again. And real yields are important because, one, you can guarantee that you get this real yield. They will sell you, U.S. government sells you tips. If you buy a 2-year tips today, you get a 3% real yield. So whatever the inflation rate is over the next year, they'll give you 3% plus that inflation rate, and they'll do so for the following year as well. But notice once you get to the 5-year, you're kind of been anchored around this 180-ish level really for the bulk of this year. And why this is important is that last year when we saw a re-rating of the equity market, a lot of it was attributed to real yields. Real yields going up, that affects the multiple on the equity market. And so I did have a question recently from a client saying, well, why if real yields are going up, why is the equity market so strong? Well, if you notice here, really the real yields themselves between the 5s, 10s, and 30s really haven't budged significantly this year. It's that 2-year part of the curve that the client was looking at that day. And so in general, this last push up doesn't matter as much in the 2-year part of the curve. If it does bleed over, we may see a little bit of stress on the equity multiple, which is the inverse of the earnings side of the equation. But in general, right now, this kind of moderate real yield behavior is very similar to what it's been most of the year. We all know about the strength of the labor market. If you take a look at this, it's usually when you get this uptick in the unemployment rate that it leads to a recession. So far, we haven't really had a meaningful uptick. We did two jobs reports ago. The household survey had all these self-employed losses that spiked the unemployment rate about 30 basis points. I think it was 27 unadjusted. And we saw some of that reverse in the last print. So in general, this isn't flashing you a warning sign at this point in the cycle. And this also allows the Fed to continue to be as aggressive as they want to be. Because we know Jay Powell's favorite chart is the one I'm showing on the screen right now, which compares the amount of job openings out there for the people who are available and looking for work. And that's defined as those who are unemployed, but they're still in the labor force. And so if you take the ratio of these, and Jay Powell talks about this, that's the black line at the bottom, what you see is that there has been some improvement in the picture. The gap between the blue and the orange line is closing a little bit, but in general, it's not as closing as fast as the Fed would like. And so, it's kind of perverse in some way when you think about the Fed. They're talking about slowing the economy down. They believe there's a relationship between the unemployment rate and inflation because they think wage growth is really what drives inflation. And therefore, in order to be able to get the labor market or be able to kind of slow the economy down, they essentially want job losses, or they at least want some better balance of the market. And this is the other chart they're looking at here in terms of wage growth. And you can see that the average hourly earnings have been declining. That's the red line. The part of this is composition mix, that there's been some of the lower end job creation on the lower wage front, or at least those that the wages haven't been growing as much. But also, if you look at that blue line, which is the Atlanta Fed wage tracker, which actually compares the same cohort, so it kind of controls for the composition of the labor force, you can see that that's been ticking down a little bit as well. But these are numbers that are meaningfully higher than anything that we saw in the last 2 decades. And so this causes the Fed concern. They like to see the directionality here. But again, I don't think that they're done with their fight at this point. So, the market says they're hiking tomorrow. We all believe the market. We all believe that the Fed hikes tomorrow. They're going to give you the 25 basis points. The market says there's a 25% chance of a hike at the September meeting. It's probably in the early November meeting that the next hike comes, if it does. And that's got about a 50% chance right now. So again, the market says you're probably close to the end of the hiking cycle. The markets did start to reprice this after the last Fed meeting when we saw more prompts. And so ultimately, we're late stages of the hiking cycle. The Fed, even though the Fed, once they get to terminal and they stay there, they're going to stay there for a period of time. So I don't believe, unless we're absent some significant deterioration in the economy, and I mean a meaningful deterioration, would you see a Fed cut in 2023? And so I think by the time the Fed gets around to cutting at this stage, it could be a little bit too late. And so there's a story making rounds on Bloomberg of an interview I did where it says I'm predicting doom and recession. It's going to be so deep they cut 100. I said, no, by the time the Fed cuts, they will probably cut 100 basis points. Why? Because they'll be late to the party, just like they were late to the hiking party as well. So let's go to markets. Let's see what the markets have been doing based on all this. And the first thing I want to talk about is volatility. And so these are forward-looking expectations of volatility. So these are implied vol measures. The red line is high-yield credit. Notice that line has been eroding since we got to the peak in rates last year. The green line, which is FX volatility or currency volatility, same thing. Notice that the equity market, VIX volatility, has also been a downward trajectory. But notice what hasn't, that blue line. The blue line is the actual bond market volatility. And so this is the equivalent of what it's the equivalent of the VIX, something called the MOVE. I can't remember exactly, but it's option volatility estimate. It comes from B of A. And effectively, it's very similar to what's on the VIX side. It's talking about forward-looking vol on rates. And you can see here that now the market is starting to price in a much more volatile rate market, even though we know that the Fed is getting closer to the end of the regime. So once bond market vol settles down, I just wonder what it's going to look like for the other markets, as really they're at some of their lower levels post-pandemic. And this is why there's been a lot of volatility. There's been a very neurotic market out there. We had the big rate hikes. It started late. The rate hike started in March of last year. And you can see what's happened is the market started to reprice this. You see 2s, 5s, 10s, and 30s, with most of them peaking around, as I said, early October of 2022. The 2-year got a little bit higher than that. The high still in this part of the cycle is, I think it's really the day before Signature Bank went down and Silicon Valley Bank went down the following day. I believe that was the high in the 2-year, if memory serves. But you can see how much it diminished and repriced. And then all of a sudden, we've been on this upward trajectory once again. But notice that the rest of the markets aren't really corroborating this. Yeah, the 5-year got kind of close again. At some point, the 5-year is going to be the way you want to bet on the Fed starting to cut rates. I think that you get better bang for the buck in terms of duration versus the 2-year. But notice what's happened. 10s and 30s kind of, they've been sitting. It's tough for the 10-year to break above 4%. We did it on what I'll call the ADP day this month when the ADP jobs report came out. And it was roughly 500,000 jobs. It was north of 400,000. And the market really freaked out on that day. I think we closed 405 on 10s or something like that day. But it hasn't really held. And notice too, the long bond, same thing. That 4% has been somewhat elusive. And so it seems that the bond market is consolidating, even though you have this upward trend. I'd want to see much more pressure on the 4% level to really consider this a breakout of this kind of range bound that we've been in. But in general, what you see here is that, now there's an inflation premium baked into markets. 4% yield is very interesting. Doesn't yield as much as cash. But I like to remind folks the reason for owning some of this stuff, especially the 10s or 30s, is that they can rally meaningfully if the economy rolls over. And to give that an example, or I should say to put that in perspective, look at page 35 here. And this is just a drawdown. So this takes peak to trough. So, that peak that you see, the last peak that you saw in the 30-year Treasury there, that's when yields were at their all-time low in the long bond. That comes back into 2020. I believe it was August of 2020 that you saw the lows there. And then you can see what kind of sell-off you had from that point in time. Now, I'm not saying that all of a sudden rates will go back to the lows. I think the long bond got down like 1% on a close basis. I don't expect it to go back down to those levels, but it would be easy during a recession for this to retrace half of this loss. So again, for investors looking for some protection, this could be a place to put, this could be a way of putting this into a portfolio. We don't have any of this trade on today, but it is something that we're thinking about. And if we start to see some more deterioration in the U.S. economy, which again, I don't expect in the very near term, but I could see that happening, later in this year. Potentially, it's a place to put on this type of trade in this portfolio or these portfolios. We all know the yield story. I like to go through a little bond math with folks, or what we call it around here, just math. But if you have a 4.79 yield on the ag today, and again, this is an unmanaged index product, you can buy ETFs that reference it. Look at what you can do to the yield in the Treasury market and what your returns will be. So you could take a 75 basis point increase in yield today, and you would still have a positive rate of return over the course of the next year. And so it's very important as an investor to think about, I think the number is 77 where you break even today. But it's very important for investors to think about is that where we live mired in this world where you had extremely low yields, you had a lot of interest rate sensitivity. Now today, you live in a world that actually can generate some positive rates of return. And by the way, let's just say the yield on the 10-year came in 100 basis points. This shows that you could do something in the double digits with a boring vanilla fixed income portfolio. If you look at the performance year to date, 2023 has been kind to most parts of the overall fixed income and floating rate markets. You can see here some of the best performers have been floating rate assets. Things like CLOs, especially at the lowest rated investor grade tranches, doing over 8% year to date. You can see leveraged loans themselves, even at the lowest level of the credit rating, the CCC rating, only did about 8%. And I remind you that this is in an environment where floating rate coupons and liabilities have went up for these corporations. And so been a very, very strong performance in this market today. But by the way, these loans carry at high single digits, in some cases, double-digit coupons today. Look at the strength in the high yield market. This is not reminiscent of a recession. The type of returns here, we've been led by the CCC part of the market here as well. You see emerging markets have done quite well. Some of that is the weakness in the dollar we've seen on a year-to-date basis. The ag itself has done 2.3, and the laggards here are the Treasury market, agency mortgages, things that are government guaranteed, and also the non-agency mortgage market. Non-agency CMBS market. And this is important because if you look at non-agency CMBS, prior to March of this year, they actually were generating a positive rate of return. It's been a lot of struggle in this area. As I'll show you, some of the yields have gotten to very wide levels in this space. And so when you look across broad indices, you can see here what this is a range of the last decade. So it takes all the trade days over the last 10 years and says, okay, what has the range been? That's the min and the max. You have the blue bar, which says on average where you've been. You can see on average things have been a lot lower towards the bottom of those ranges and where we are today. And so you can see where is stress in the market today. Well, what we should look at is what's at the highest levels of those areas. Is it treasuries? Well, treasuries don't signify stress. It's a function of Fed policy, part of that. IG, maybe it's a little bit higher, but spreads are tighter today than when they started the year. I think we started around 125, call it. We're at the low 110s or so today. But look on the right-hand side, at least the third one from the right-hand side, triple B minus CMBS. Well, this is reflective of kind of what people expect within the commercial real estate market. And you can see here that we went from an average yield of about 6.8% today, that this investment grade rated tranche yields about 15.2. Now, does the market think that these are investment grade rated tranches? I don't know. Maybe we should compare it to high yield spreads. Let's see. What is high yield today? 8.3%. And mind you, high yield is a single B asset when you take the weighted average of the whole universe there. And a single B roughly asset, let's just call it the whole market, is 8.3%. Well, if you're getting paid double that, the market sure does not think that that's going to be investment grade. And in fact, the ratings agencies have a lot of these on watch. So you're going to see some significant downgrade pressure. It could create a very meaningful opportunity if there's some forced selling as well in that space. But also notice that CLO double Bs, pretty attractive. When you go down in some of this securitized credit, as you get into the lower rate and below investment grade tranches, there is significant yield. And so, given these are closed-end funds, they tend to run on the riskier side of the credit spectrum. Yes, we have some balance in the portfolios, but they do traffic more in these areas. You can see here what kind of yields you're getting in the lower credit quality tiers. And things even like double B, single B bank loans yield about 10% today. Single B emerging market corporate bonds, about 10%. Double B CLOs, 13.5%. Double B ABS securities, so these are MPLs or marketplace lending, about 13%. They do have risk in them, okay? But again, when you get a lot of 13s, if you can carry these coupons, they can be quite helpful. But you notice here that conduit, those triple B CMBS that I was talking about, the only thing that yields greater than that are triple C bank loans and triple C emerging market corporates. So I think you can kind of just intuitively glean from this and say, well, maybe those triple B CMBS bonds are on their way to a triple C type of rating. And so again, for those that say, well, they want yield, there is yield out there. Now, granted, this is going to be, you're going to have to pick your spots here. You're going to have to manage through this, but these are just generic index type of yields. And so we also know that if you look at the average dollar price, there's still the potential for a strong total return. And so we do is we compare the dollar price of a lot of these sectors of the market to today's prices to where they were at the end of 2021 before the hiking regime started. And you can see here, look at those triple B CMBS again, 62 cents on the dollar on average. That is the average of the overall market is 62 cents on the dollar. So not likely that you're going to get par back at maturity on at least on all those assets. But again, the ability, if your recoveries are solid, you do the underwriting, there is the potential for a strong total return. Secondly, the other thing is that you don't have to hold these securities till maturity. You buy something, it's a bit cheap, prices rally in this kind of market that we're seeing today, prices have been rallying, you can go and sell those securities as well. So there is something very attractive about today's market that it brings the tradability of some of these asset classes back into vogue. Now, the thing is, you have to buy something to sell something, or sorry, if you sell something, you got to buy something back in these type of portfolios. And so anytime you're trying to do that, you're trying to either improve the quality or improve the distribution yield of the overall portfolio. And so lastly, it's a slide I like to use about the distribution set. It's not just about yield. It's also about how much interest rate sensitivity you have. These are closed-end funds. They really don't try to look anything like the index. In fact, these portfolios look nothing like their respective indices. The indices are there to give you a broad sense of what those markets are doing. But you can see here that you don't have to take significant duration risk today in order to go out there. Now, obviously, things with very high yield and low duration risk probably have higher credit risk as well. So I didn't want to put a 3D chart here together for everyone today, but just showing people that the opportunity set there is there. There's a lot of assets that yield 6 to 9%, and these are just broad indices. And so with active management, we hope to do better through a cycle.